Hey everyone, welcome to today's lecture on one of the most fascinating and significant topic areas for your CFA Level 1 exam preparation, equity, specifically market efficiency. We'll talk about the concept of market efficiency, different forms of efficiency, factors that affect efficiency, and we'll weave in the real-life examples, a bit of investor psychology, and helpful analogies along the way. By the time we're done, you'll have a thorough understanding of why market efficiency matters, what to watch for in the real world, and how to tackle these exam questions. Now, strap in and get comfortable because we're in for a comprehensive, detailed discussion that ensures you don't miss a single point you might need on exam day. Look, I know studying for the CFA can feel like climbing Mount Everest in flip-flops. But these summaries you're seeing on screen, they're like having a helicopter lift you straight to the top. Everything's broken down exactly the way your brain needs it. No fluff, no confusion, just pure grade A content that sticks. Real talk, I wish I had these when I was studying. You're going to want to print these bad boys out and keep them closer than your phone. They're that good. The download link is right below. Do yourself a favor and grab them now. Your future self will literally thank you. All right, folks. If you've ever wondered whether you could outsmart the stock market by just reading the news a little faster than everyone else, well, today's topic is going to challenge that idea. We're talking about market efficiency, one of those foundational CFA Level 1 concepts that sounds kind of dry on paper, but stick with me because it's actually one of the most eye-opening ideas in all of investing. Let me first set the stage for what we mean by an efficient market. An efficient market, also known as an informationally efficient market, is essentially one where security prices immediately, fully, and accurately reflect all available information about their fundamental values. In other words, in an efficient market, if some new piece of pertinent information about a company hits the news, say the firm discovered a brand new product line that will boost profits, then we'd see the firm's stock price adjust super quickly, almost as if it instantly knows this new development. This concept sounds a bit theoretical, but it has tremendous real-world implications. Imagine you wake up one morning and read that a giant tech company, let's call it tech guru, has unveiled a revolutionary artificial intelligence chip that's faster and cheaper than anything on the market. If the market is truly efficient, tech guru's stock should adjust upward right away, reflecting the value of that new technology to the firm's future cash flows. You shouldn't be able to make an easy buck by buying the stock after reading it on the front page if everyone else has that same information and has already acted on it. When we say prices are informative, we're talking about the fact that once the new information is out there, the market quickly digests it and sets a price that fairly represents the intrinsic or fundamental value of the underlying security. That means you, me, and everyone else out there wouldn't be able to get a consistently superior risk-adjusted return by trading purely on that piece of public info. I want to emphasize that risk-adjusted part. Sometimes people say, well, I made a killing in the market by going for riskier stocks. The idea here is that in an efficient market, any additional returns you're getting by piling on risk are essentially offset by the extra risk you're taking. If you measure your returns in a way that accounts for risk, it's not possible to systematically beat the market by using information that everyone else already has. So keep that in mind. The math often shows abnormal return is equal to actual return minus expected return. Here, that expected return is what you'd normally anticipate for a given level of risk. Picture this. You're scrolling your news feed and see that Tesla just announced record-breaking deliveries for the quarter. You rush to your trading app to buy some shares, thinking, I'm going to ride this wave. But when you check the price, it's already up 6%. That's market efficiency at work. The idea is, by the time you see the news, thousands of traders, algorithms, and institutions have already seen it, analyzed it, and traded on it. Boom, price adjusted. So in an efficient market, prices reflect all available information, not later, not tomorrow, right now. And this includes everything: past data, current earnings, breaking news, even surprises nobody saw coming. A critical point is that in reality, a market is never 100% perfectly efficient, nor is it 100% inefficient. We're dealing with degrees of efficiency. A lot depends on market structure, the number of participants, how transparent things are, and how stringent the regulations might be. Generally, the more efficient a market is, the more it benefits society overall because it allocates resources more effectively. Companies that have truly profitable ventures get funding, while weaker opportunities get weeded out. That fosters economic growth and is the reason many regulators work hard to reduce insider trading and enforce disclosures. They want markets to be as fair and efficient as possible. So, folks, bottom line so far? An efficient market is like a supercomputer plugged into the internet 24/7. It doesn't miss a beat. When new info comes in, whether it's Apple launching a new product or inflation data being released, prices adjust fast. Not eventually, instantly, and not randomly. They adjust accurately and rationally based on what that information actually means for the future value of an asset. So if a stock's intrinsic value should now be higher because of good news, the market pushes the price up right away. If the news is bad, down it goes. And this isn't just theory. It happens all day, every day, in real time. Now here's a key point. You can't consistently beat the market just by acting on public information. Why? Because it's already in the price. Unless you have insider info, and let's be clear, trading on that is illegal, you're not going to get ahead just by being fast with the headlines. Here's an example that hits close to home. Think about Netflix. Every time they release subscriber numbers, Wall Street reacts immediately. I remember this one quarter, Netflix missed growth targets by just a hair. Within seconds, the stock dropped like a rock. There was no lag, no chance to beat the news. The market just absorbed it and moved. That's the kind of thing CFA Institute is talking about when they say prices are informative. They quickly and correctly reflect any change in what we think the asset is worth. Now hold up. We're not saying all markets are equally efficient all the time. Far from it. No market is 100% efficient, and some are way less efficient than others. Think of a sleepy, emerging market stock exchange versus the New York Stock Exchange. One has billions of dollars and lightning fast AI trading on it. The other might have a couple of analysts and a few dozen investors. So efficiency can vary by country, by asset class, by how frequently the asset trades. Even the same market can be more or less efficient over time, depending on what's going on. And here's the fun part. The less efficient a market is, the more opportunity there is for sharp investors, like maybe you someday, to take advantage of mispricings. That's where active investing comes into play. But in highly efficient markets, you're usually better off just riding the index through passive strategies, because beating the market consistently is like trying to win a race where everyone's already crossed the finish line. So why do we even want markets to be efficient? Well, for starters, informative prices help money flow to the right places. If the market correctly prices a company like Nvidia, then that company can raise capital at a fair rate to fund future innovation. If prices are wrong, capital ends up getting wasted. Think of it like GPS for the economy. When it's accurate, we all move in the right direction. Efficient markets also help drive economic growth because resources are being allocated where they can do the most good. If investors can trust that prices are fair, they'll invest more. More investment means more businesses growing, more jobs being created, more innovation, all good stuff. It's also worth noting that the time frame in which prices adjust can vary. In some super liquid, well-watched corners of the market, prices might adjust in seconds or even milliseconds. Think high-frequency trading on the New York Stock Exchange. In other less liquid or less researched areas, it might take longer for new info to fully reflect in the price. The basic requirement is that the time frame for adjustment is at least as long as the period a willing trader needs to exploit that information. That's what we mean by the market is efficient enough to eliminate easy opportunities to profit without incurring risk. Now let's pivot to a concept that often comes up on the exam. The difference between market value and intrinsic value. Market value. That's just the sticker price. It's what the stock is trading for on any given day. It is simply what you can buy or sell the asset for right now. You open your app, you see the price, boom, that's it. Intrinsic value, that's what you think the stock is actually worth based on your analysis. It's the discounted present value of all future cash flows from that company. Of course, that's not a hard number, it's an estimate. And everyone's estimate is a little different because we all make different assumptions about risk, growth, cash flows, you name it. So, folks, let me repeat. Market value is like, if I can log into my brokerage app and see a stock trading at $50, that's its market value at that moment. The tricky part is that no one truly knows the real intrinsic value. Even the best experts can only estimate it using models like the dividend discount model or discounted cash flow analysis. And these models themselves carry assumptions about growth rates, discount rates, and so on. So if an investor is overly optimistic about a company's future growth, they might come up with a pretty high intrinsic value. Meanwhile, if another investor is more pessimistic, they'll get a lower intrinsic value. That's why we have differences in opinions that create trading volume. People disagree. Now, if the market is super efficient, guess what? Market value is equal to intrinsic value, more or less. But if there's a disconnect, maybe the market value is below what you think it's worth, that's when an opportunity pops up. You might decide, hey, this stock's undervalued, time to buy. Or if it's trading above what you think it's worth, maybe it's time to sell. That's the bread and butter of active investing, spotting those gaps. But again, those gaps only exist if the market isn't efficient. And that's exactly why understanding market efficiency is so critical. It helps you decide which investment strategy actually makes sense in a given market. All right, friends. So far, we've unpacked what market efficiency is, why it matters, and how it plays out in real life. Now let's roll up our sleeves and look at what actually makes a market efficient or inefficient. Because let's be real, market efficiency doesn't just happen by magic. It depends on what's going on inside the market, who's participating, what kind of information is flying around, and how easy or hard it is to actually trade. Let's break it down. So first up, market participants. These are all the folks trading, researching, or analyzing securities. Retail investors like you and me, big hedge funds, portfolio managers, financial analysts, and so on. The more people you've got actively involved in a market, the more efficient it becomes. Think of it like this. If only 5 people are trading a stock, chances are some info might slip through the cracks. But if you've got thousands of investors all combing through data, doing valuations, and watching every press release like hawks, it's hard for a mispricing to stick around for long. Now here's where it gets interesting. Some markets limit participation, especially by foreigners. So if you're a foreign investor and you're restricted from buying or selling in a certain country's market, that's fewer eyeballs, fewer trades, and less efficiency. Less action means prices may not reflect reality as quickly or as accurately. Next, let's talk about information, the lifeblood of any efficient market. If people don't have access to quality, timely, and reliable information, the market can't do its job. Plain and simple. That's why financial disclosures, reporting standards, and even the media matter so much. A market with strong disclosure rules and a super active financial press will be way more efficient than one that's quiet and opaque. Let me give you a real hook here. In the US, we've got this rule called Regulation Fair Disclosure, or regular FD. Basically, it says if a public company shares material, non-public information with any analyst or bigwig investor, they're legally required to make that info public at the same time. It's all about fairness and creating a level playing field. That kind of regulation helps prevent backroom deals and ensures prices reflect everyone's understanding, not just the privileged few. All right, now imagine this. You spot a pricing error, like the same stock is trading at slightly different prices on two exchanges. In theory, you could buy it cheaper in one market and sell it for more in the other. Easy money, right? Not so fast. This is where limits to trading come in. Sometimes, even if you see an opportunity, the system makes it hard or just too expensive to act. Maybe transaction fees are too high. Maybe the market's illiquid and you can't get your order filled. Or maybe short selling is restricted, so you can't bet against a stock even when it's clearly overvalued. These are real-world speed bumps, and they matter because if people can't take advantage of pricing errors, those errors might stick around. And that, my friend, makes the market less efficient. Side note, short selling gets a bad rap sometimes, but it actually plays a key role in price discovery. It's not just about betting against stocks. It's about making sure prices reflect both sides of the story. Let's say you find a small arbitrage opportunity. A stock is 10 cents cheaper on one exchange than another. Technically, you could profit by buying low and selling high. But if your transaction costs, like commissions, fees, or bid-ask spreads, are more than the profit you'd make, then guess what? That trade's not happening, and no one else will bother either. This is why super liquid markets like US Treasuries or large cap equities tend to be more efficient, because trading is cheap and fast. The tighter the transaction costs, the more likely people are to step in and correct mispricings. It's like having no tolls on the highway. You get to your destination faster and smoother. But in less liquid markets with wide spreads and high fees, it's like trying to drive through a city where every street has a toll booth and a traffic jam. Finally, let's not forget information acquisition costs. Gathering and processing information takes time, effort, and often money. Whether it's hiring analysts, buying research, or subscribing to data services, none of it's free. Here's the key idea. If all that work just gives you a normal risk-adjusted return, nothing extra, then the market's considered efficient. But if you consistently earn abnormal returns, even after deducting those costs, well, then something's off, and the market might be inefficient. So, transaction costs can have a direct effect on arbitrage. If the discrepancy in prices is smaller than your trading fees, you're not going to bother executing an arbitrage trade. That means the mispricing remains. We call this bounds of arbitrage, which is the range within which prices can deviate from fair value but still not be enough for someone to do something about it. In highly liquid markets, those bounds of arbitrage are very narrow because trades are cheap and easy to execute. In less liquid markets, the bounds get wider, allowing for bigger, more persistent mispricings. Similarly, it costs time and money to acquire information. Maybe you pay for specialized financial data feeds, or you have to hire analysts to dig into a company's financials. If it costs you $10 in research to earn an extra $10 in returns, again, risk adjusted, then you've just broken even. So in that scenario, we'd say the market is still efficient because you didn't actually get ahead net of cost. If you can earn more than enough to cover those information costs, then you might say the market is less efficient. So, efficiency doesn't mean prices are perfect. It just means prices are good enough that once you account for costs, there's no easy way to game the system. And again, if you're thinking, man, this is a lot to process, that you're not alone. That's why at FinQuiz, we created these smart summaries you're seeing right now. They take all of this CFA curriculum content, the definitions, the nuances, the formulas, and compress them into clear visual summaries that stick. Whether you're reviewing on the go or need a quick refresher before mock exams, these summaries give you that edge without drowning you in details. You can grab them on our website, and honestly, they've helped thousands of candidates just like you. All right, back to the lesson. So let's tie it all together. Market efficiency isn't just about the theory. It depends on how the real-world machine is running. More traders, more efficiency, more information, better pricing. But throw in high costs, trading restrictions, or limited access, and suddenly the machine gets a little rusty. As a CFA candidate and future investment pro, you'll need to understand where markets sit on the efficiency spectrum. It's not black and white, it's shades of gray. And spotting those shades is what separates great investors from the rest. Next up, we'll dive into the forms of market efficiency. That's where things get even more fun. Weak, semi-strong, strong. What do they mean? Which ones actually hold up in the real world? So stick around, smash that like button if you're finding this helpful, and let's keep leveling up together. Now let's talk about the flavors of market efficiency, because yes, it comes in 3 different strengths, like your morning coffee. This part is important, especially when you're trying to figure out which strategies work where. So pay close attention. We're going to look at the 3 forms of the efficient market hypothesis, or EMH for short: weak form, semi-strong, and strong form. Let's take them one by one. So let's kick off with weak form efficiency. This is the most basic version. The idea here is that stock prices already reflect all past trading data. We're talking price history, trading volumes, all that good stuff. You can think of it as, look, if you're just analyzing how the stock traded last week or last month, sorry, but that's already in the price. You're not going to gain a consistent advantage using charts alone. Now here's the punchline. If a market is weak form efficient, you can't consistently beat it using technical analysis. That's the kind of analysis that looks at charts, price trends, moving averages, basically trying to read the tea leaves of past prices. And here's why it doesn't work. In a weak form efficient market, all of that info is already baked into the current price. So the market's not going to reward you for spotting that head and shoulders pattern on a chart. It already moved. Now, just to be clear, weak form efficiency doesn't mean prices move randomly. It just means you can't profit from patterns in historical data because everyone already sees the same patterns and they've already traded on them. But here's a little twist. Even if you do find patterns, the profit might not actually be there after costs. Say you found a trade setup that seems to work, but once you factor in commission spread slippage, it's gone. That's why serial correlation in returns might exist, but still not lead to profitable trading. If a market is truly weak form efficient, then technical analysis, where folks look at past price patterns, candlesticks, or support resistance lines, should not, on average, let you outperform the market after factoring in transaction costs. You might still get lucky once in a while, but consistently beating the market this way should not be possible. However, it doesn't rule out the possibility that using fundamental analysis or even insider info could work. That's because weak form is specifically about past price and volume only. So yeah, technical analysis might still have some life in developing markets where things aren't as efficient, but in developed markets, it's usually a dead end. Researchers have tested weak form efficiency by looking at whether there's serial correlation in returns, or if any known trading rule based on past data can reliably generate alpha, abnormal returns. If they don't find evidence of consistent abnormal returns, that supports the idea that the market is at least weak form efficient. Interestingly, for well-developed markets like in the US or Western Europe, the data generally does support weak form efficiency. But in less mature or developing markets, you may occasionally see patterns that can be exploited, so there might be opportunities for technical analysts. All right, moving up the ladder, next we've got semi-strong form efficiency. This one takes it a step further. In a semi-strong efficient market, prices reflect not just past data, but also all publicly available information. That means earnings reports, dividend announcements, mergers, management changes, macroeconomic news, you name it. Like pretty much anything that's out there in the public domain. So if you're trying to analyze financial statements to find undervalued gems, here's the catch. You're probably not the first person to see that info. In a semi-strong market, the second public info is released. The market reacts fast. By the time you click buy, the price has already moved. If the market is truly semi-strong efficient, you can't consistently beat it by poring over annual reports, analyzing economic indicators, or investigating industry trends, because that data is already priced in. Once news hits the wires, the market price adjusts quickly. This means fundamental analysis shouldn't provide a consistent edge. You can probably guess that insider information, stuff that's not publicly known, would still potentially give you an edge in a semi-strong form market, because the hypothesis states that only publicly known info is fully reflected. So what's the implication here? Fundamental analysis doesn't work in semi-strong markets, at least not consistently. It's not about being smart, it's just that the game's already been played by faster and better equipped players. This is why index investing is so powerful in developed markets. You don't have to beat the game, you just ride with it. And as I said, insider trading still works here because semi-strong efficiency only deals with public info. So if you've got access to something the public doesn't know yet, like a CEO leak or pre-earnings whisper numbers, yeah, you can still earn abnormal returns. But again, trading on that is illegal, and the CFA Institute would really prefer you not do that. Now, how do we test this form? Through event studies. Basically, you look at how stock prices react around events like earnings announcements. If prices adjust quickly and there's no predictable drift afterward, that supports the semi-strong form. For large developed markets, semi-strong form is also generally accepted, meaning it's tough to outperform consistently by combing through publicly available data. However, smaller markets or certain niche sectors might not exhibit the same degree of efficiency. And just like before, semi-strong implies weak form. If public info is already reflected, then obviously so is the historical data. Now let's talk about the strong form of market efficiency, and this one's hardcore. According to strong form efficient market hypothesis, prices reflect everything. I mean everything. Past prices, public info, and even private insider information. Sounds kind of wild, right? In this world, not even insider traders can make abnormal returns because every scrap of info that could possibly affect the stock, it's already in the price. All information, public and private, insider info, boardroom whispers, regulatory leaks, everything is already factored in. If strong form efficiency truly existed, insider trading wouldn't be profitable because that inside scoop would already be reflected in the price somehow. So what does that mean for professional investors? In a truly strong form market, even hedge funds, fund managers, and analysts can't consistently beat the market. That alpha, it's gone. The market's already too smart, too fast, and too efficient. Now here's the reality check. This level of efficiency doesn't really exist, at least not in most real-world markets. Why? Because we know insider trading does result in abnormal returns. That's why it's illegal, and that's why regulators go after it hard. So yeah, strong form EMH is more of a theoretical limit than something we see in actual financial systems. And just like before, if a market is strong form efficient, it has to be semi-strong and weak form efficient too. It's like a hierarchy. Strong includes semi-strong, which includes weak. So let's bring it back to what you need to know as a CFA candidate and future investment pro. In most developed markets, research shows weak form and semi-strong form efficiency generally hold up. That means neither technical analysis nor fundamental analysis will reliably get you ahead. Your best bet? Passive investing, or using very sophisticated strategies that account for things like behavioral biases or structural inefficiencies. But in developing markets, things are messier. They're less transparent, have fewer participants, and often slower price adjustment. That means some forms of technical or fundamental analysis might still work, but you've got to factor in transaction costs and risk. Bottom line, understanding the form of market efficiency you're dealing with helps you figure out what tools are worth using and which ones are a waste of time and money. All right, so now you've got the lay of the land. The three forms of market efficiency, what they mean, how they differ, and why they matter. Next up, we'll start connecting the dots to real investment strategies and look at behavioral finance. Because believe it or not, sometimes human emotions mess with efficiency in really fascinating ways. So folks, remember, just because a market is efficient doesn't mean you stop thinking. It just means you've got to think better. All right, folks, you're doing great sticking with me through this topic. It's a big one, but absolutely essential. So now that we've broken down the three forms of market efficiency, let's ask the next big question. What does all of this mean for you as an investor or analyst? Let's start with the tools of the trade: fundamental analysis, technical analysis, and good old-fashioned portfolio management. Fundamental analysis is all about digging into company details, financials, growth outlook, industry trends, inflation expectations, and so on. You're trying to estimate what an asset is actually worth, its intrinsic value, and then compare that to the current market price. If the market price is lower than what you believe the stock is worth, you buy. If it's overpriced, you sell. Sounds like a solid plan, right? Well, if we're living in a semi-strong, efficient market, and remember, most developed markets lean this way, all that public info you're using is already baked into the price. That means your chances of consistently beating the market through fundamental analysis? Pretty slim. So theoretically, you can't systematically beat the market by analyzing something that's already public. But fundamental analysis is still crucial because it helps the market remain efficient. As you and thousands of other analysts do the deep research, any mispricing that arises is quickly spotted and traded on, snapping the price back to fair value. So ironically, fundamental analysis is partly what helps keep the market efficient. Even if it doesn't guarantee alpha, it helps the market stay efficient. When analysts pore over earnings and issue buy-sell ratings, that info feeds into prices, helping correct mispricings faster. So in a way, you're not just analyzing the market, you're helping build it. Now let's talk about technical analysis, the art of reading charts like they're ancient scrolls. Moving averages, candlestick patterns, RSI signals, you've probably seen some of this stuff on trading forums or finance TikTok. But here's the deal, if the market is weak form efficient, none of that really works. Why? Because the price already reflects all that past price and volume info. Whatever you're seeing on the chart, so is everybody else. And they've probably already traded on it. Plus, even if you do find a pattern that seems to work, by the time you factor in transaction costs, taxes, and bid-ask spreads, poof, there goes your edge. And let's not forget, if a price pattern becomes popular, it often stops working. The market adapts. Still, in less efficient markets, technical analysis may still have a place. But in the big leagues, it's more noise than signal. Right, now here's a question I get all the time. If markets are efficient, what's the point of having a portfolio manager? Great question. The role of a portfolio manager in an efficient market isn't just about beating the index. It's about building a portfolio that makes sense for the investor, one that matches their risk tolerance, tax situation, liquidity needs, and long-term goals. Even if returns are just market returns, how you get those returns can vary wildly based on asset allocation, diversification, and proper rebalancing. So yes, portfolio management still matters a lot. And by the way, a lot of studies show that active managers underperform passive benchmarks, especially after accounting for fees. Their gross performance might be about the same as the market on average, but once you layer on management fees and transaction costs, they typically lag. That's why passive index investing has become so popular. If you can't reliably beat the market, just join it at a low cost. Meaning, unless you have a very good reason to go active, passive strategies tend to win the race in efficient markets. All right, let's now jump into something a little more mysterious. Market anomalies. These are those quirky little market patterns that seem to break the rules of efficiency. Things that make you go, wait a minute, why does that keep happening? We'll look at two big types, time series anomalies and cross-sectional anomalies, and then wrap up with a few other oddballs that show up in markets from time to time. So if markets are so darn efficient, why do we hear about market anomalies, patterns, or tendencies in stock returns that seem to contradict the efficient market hypothesis? Let's dig into that. So folks, market anomalies are these odd patterns like calendar effects, size effects, or momentum effects that suggest you might be able to generate abnormal returns by following specific strategies. But there's a big catch. Anomalies have to be persistent, consistent, and robust over time. If they show up for a short period or in small samples, it might just be data mining or random chance. Also, once an anomaly is widely publicized, traders often jump in to exploit it, which then makes it disappear. We typically classify anomalies in time series or cross-sectional anomalies. And then there are other kinds as well, like event-based anomalies. Time series anomalies are all about patterns in returns based on time, the day of the week, time of the year, or even time of the month. Under time series anomalies, you have what we often call calendar anomalies, plus momentum and overreaction anomalies. There's the famous January effect, where some studies found that stocks, especially small cap stocks, might do disproportionately well in January compared to other months. One reason sometimes cited is tax loss selling in December. Investors want to realize losses to offset their capital gains, so they dump losing stocks in December, driving prices down. Then in early January, these same stocks bounce back as investors buy them again, or portfolio managers do some window dressing after the new year. But guess what? Once that phenomenon was discovered, it started to fade. In many markets, the January effect isn't nearly as pronounced anymore, and when you adjust for risk and transaction costs, it might not be a reliable way to make money. Similar anomalies have been observed around the turn of the month, day of the week, weekends, or holidays. But again, most of these patterns aren't strong enough to make reliable profit once everyone knows about them. As more traders caught on, the advantage faded. That's the market adapting. Classic efficient behavior. So folks, remember, the reasons of January effect can be tax loss harvesting in December, followed by rebuying in January. Or maybe fund managers doing some window dressing to make portfolios look cleaner at year end. You'll also hear about the day of the week effect, Mondays are often weak, or the turn of the month effect, returns cluster at the start and end of each month, or even the holiday effect, pre-holiday optimism pushing up prices. Then we have momentum and overreaction effects. Momentum says, if a stock's been rising, it'll probably keep rising for a bit. Same with losers. They tend to keep falling. Sounds like a dream trade, right? Buy winners, short losers. But again, once too many people chase momentum, the profits evaporate, and it doesn't always work after costs. Then there's overreaction, the drama queen of market behavior. Stocks that shoot up too much on good news tend to fall later, and those that tank on bad news often bounce back. In the short term, the market can be a little emotional, but in the long run, it usually sorts itself out. Overreaction is sort of the flip side. If a stock has extremely positive or negative news, the market might overshoot in the short term, causing a price spike or crash that isn't fully justified. Over time, and say 3 to 5 years, the price corrects, and the winners might underperform while the losers bounce back. This can look like a contrarian strategy. Buy the losers and sell the winners. When we consider the actual transaction costs, however, we find conflicting evidence regarding these exploitable and persistent momentum or overreaction anomalies. The academic perspective suggests that while these anomalies may show up in the data, they can usually be exploited and eliminated pretty quickly. Now, cross-sectional anomalies are about differences between types of stocks. One classic example is the size effect. Small cap stocks historically outperform large caps on a risk-adjusted basis. Another one is the value effect. Stocks with low PE or low market-to-book ratios, so-called value stocks, tend to outperform high-growth stocks. But here's the twist. Once you control for other factors using more advanced models, like the Fama-French three-factor model, a lot of that value advantage disappears. So are these anomalies real? Maybe, but they might also just be quirks in how we were measuring things. Let's wrap this anomalies segment. There are a few other anomalies that frequently pop up in textbooks and discussions. First up, closed-end fund discounts. These funds often trade below the value of the assets they hold. Why? Maybe taxes, maybe liquidity issues, maybe investor sentiment. But whatever the reason, these discounts tend to revert to the mean, so they're not always reliable sources of alpha. Need more explanation? Closed-end funds are those that trade on an exchange but only have a fixed number of shares. Often they'll trade at a discount or occasionally a premium to the net asset value of their holdings. Some folks see that discount and say, wow, easy money. I'll buy the fund cheap because it's worth more if you sum up all the underlying holdings. But the discount might persist because of intangible factors like market sentiment, tax liabilities, or liquidity. Studies generally find that trying to exploit this discount is not a surefire path to alpha once you factor in costs and the risk that discounts could widen further. Over time, these discounts might revert, but it's not consistently profitable in a strong sense. Then there's the earnings surprise anomaly, stocks reacting to earnings that beat or miss expectations. Seems like an easy win, right? Not so fast. Most of the reaction happens before or at the announcement. By the time you trade, it's already priced in. So, folks, an earnings surprise is simply when a company announces earnings that differ from what the market consensus was expecting. If a company beats expectations, the price typically jumps, sometimes even before the formal announcement because people guess or glean signals. According to the efficient market view, that price jump or drop should happen quickly around the announcement, leaving no easy opportunity for abnormal profit once it's out. While there might be a short-term drift, Many studies show it's hard to exploit consistently. Same deal with IPOs. On day one, prices often shoot up. That's called underpricing, and it's mostly due to risk and uncertainty. But long term, IPOs usually underperform. Investors get excited early, then reality sets in. You've probably heard that many IPOs pop on their first day. Basically, they list at X dollar, and by the end of day one, the price might be 10%, 20%, or even 50% higher. That's because underwriters typically want to err on the side of underpricing to ensure the IPO is successful. If you manage to buy at the offer price, you'd profit from that pop. But remember, not everyone can get that allocation. Then, over the long run, many IPO stocks underperform. Possibly it's because the initial mania is an overreaction and reality sets in later. Or it might just be risk compensation. Either way, it's not a straightforward anomaly you can easily exploit. And finally, there's this idea that stock returns are predictable based on things like interest rates, dividend yields, or inflation. While relationships do exist, they're not reliable enough to build a strategy on. And again, once costs are considered, the edge disappears. Does that mean the market is inefficient? Not necessarily. Because in an efficient market, rational relationships can still exist. The real question is whether you can systematically generate alpha after factoring in risk. Often, the relationships vary across time and aren't stable enough to produce consistent superior returns. All right, friends. So far, we've talked about how efficient markets should work. Prices adjusting instantly, no free lunches, everything baked in. Beautiful in theory, right? But let's take a step back and ask the real question. Do humans always behave rationally? Yeah, that's what I thought. So now we're stepping into one of the most fascinating, relatable, and sometimes brutally honest parts of this journey, behavioral finance. Now, I know you are thinking behavioral finance? Really? Why? Because while efficient markets assume rational behavior, humans, not always so rational. According to the efficient market hypothesis, markets are rational and prices are always right. If something looks off, it's either chance or a statistical hiccup. But behavioral finance says, hold up, investors are human. Humans have emotions. Emotions lead to irrational decisions, and that messes with prices. So the big idea here is even if markets as a whole are trying to be efficient, the people inside those markets, us, we're flawed. We've got mental shortcuts, fears, and weird tendencies that sometimes lead to bad decisions. And when enough people act irrationally at the same time, you get mispricing, anomalies, and yes, bubbles and crashes. Let's walk through some of the main behavioral biases you need to know, both for the exam and real life. So here's the deal. Most people hate losing more than they love winning. This is called loss aversion. If you lose $100, it hurts way more than the joy you'd feel from gaining $100. It's not balanced. And here's how this shows up in markets. Investors will often hold on to losing stocks way too long, hoping they bounce back. But at the same time, they're quick to sell winners just to lock in the gains, even when fundamentals say there's more room to grow. Sound familiar? Yep, this is one reason why overreaction happens. It's emotion over logic. Ever heard someone say, everyone's buying it, it must be good? That's hurting. It's when investors just follow the crowd without doing their own homework. You see this during big bull runs when people start piling into the same hot stock or sector. Think tech bubbles, meme stocks, crypto hype. And it feels safe to go with the herd. But sometimes the herd walks straight off a cliff. This is when people copy what others are doing, not because they've done their own research, but because everybody's doing it. Think back to the Dogecoin frenzy. Tons of people started buying it, not because they understood blockchain, but because Twitter, Reddit, and YouTube were full of hype. So they followed the herd. But herds don't always run in the right direction. So, folks, following the crowd isn't always a smart move in investing. Overconfidence is one of the sneakiest biases out there. It's when people think they know more than they actually do. You believe your predictions are spot on. You trust your gut over data. You think your stock picking game is elite, when really, you're just flipping coins. A lot of young investors fall into this trap. Take a guy who just got his MBA. He's smart, sure, but he believes he can beat the market by picking a handful of tech stocks. So he ignores diversification, throws all his money into 5 names he believes in, and brushes off public data in favor of his own analysis. For a while, he's up and he thinks he's a genius. But markets don't reward ego for long. Eventually, the tide turns and his portfolio tanks. That's overconfidence. It's like driving too fast because you think you're the best driver on the road. Overconfident investors tend to trade too much, under-diversify, and ignore public info in favor of their own brilliant ideas. Ironically, the more confident they are, the more they mess up. And when lots of people are overconfident together, prices get distorted. That's where bubbles can start. All right, now this one's really interesting. Information cascades. Imagine you're watching the stock of a company you've never heard of suddenly start climbing. You're not sure why, but then you see everyone on social media talking about it. Your friends are buying it, analysts are hyping it, so what do? Chances are, you buy it too. Welcome to the cascade. This is when information, whether accurate or not, spreads like wildfire. People stop trusting their own judgment and start copying what others are doing. And that's what creates these huge chain reactions that sometimes end in crashes. Cascades aren't always irrational. Sometimes they help spread good info. But when the original info is wrong, things get ugly fast. And for your information, folks, cascades and herding aren't exactly the same. In herding, people may still use their own info. They're just influenced by others. In cascades, people ignore their own info completely and follow the group. Subtle difference, but important for your exam. Imagine this. Someone tweets that a company is about to be acquired. There's no official news, but the stock jumps 20% in a few hours. Why? Because the first few traders buy based on the rumor, the next group sees the price rising and joins in. And before you know it, everyone's trading based on what everyone else seems to know. No one stops to ask, wait, is this even true? That's how rumors snowball into market reactions. It's like everyone assuming the building's on fire just because people start running. All right, let's run through a few more classic investor slip-ups. Representativeness. This is when people judge probabilities based on stereotypes or surface similarities. This stock reminds me of Tesla, so it must be the next big thing. Dangerous logic. Representativeness is all about judging based on similarity, not logic. Picture an investor who sees a new video streaming app. It's slick, user-friendly, and reminds him of early Netflix. So he thinks, this must be the next Netflix, and buys in. But he doesn't look at the actual business model or revenue, just the surface. He's assuming that because it looks like a winner, it is one. But remember, just because something looks like a duck doesn't mean it's actually a duck. Now, let's talk about something all of us have probably done. Mental accounting. People love to create little buckets in their minds for different types of money. So you'll see someone invest their year-end bonus in crypto saying, it's found money, I can take the risk. But they refuse to invest their monthly salary in anything remotely risky. Same money, different labels, and that kind of thinking leads to bad decisions. In investing, money is money. It doesn't matter where it came from. It should all be managed with the same logic. So the bottom line is, in mental accounting, you keep mental buckets for your money, like this is my fun money or this is my safe investment. Problem is, money is fungible, and this mindset can lead to poor diversification. Next up, conservatism bias. This is when investors are too slow to adjust their views when new data comes in. Say an investor has held a telecom stock for years. Suddenly, new reports show 5G is disrupting the company's whole revenue stream. But the investor hangs on, saying they've always bounced back before. He's ignoring today's facts because he's stuck in yesterday's beliefs. It's like still using a flip phone in a smartphone world just because it used to be great. They cling to old beliefs, even when the data clearly says otherwise. Finally, we have narrow framing. This happens when investors make decisions by looking at each investment in isolation rather than as part of a whole portfolio. For example, someone might say, I'm not investing in international funds, they're too volatile, without realizing that adding some international exposure could actually lower overall portfolio risk. They're zooming in too much and missing the big picture. It's like judging a meal by just one ingredient. This has a garlic, so I won't eat it, without tasting the full dish. I've seen people get totally obsessed with a single stock without even thinking about how it fits into their overall portfolio risk. These little behaviors add up, and over time, they can really hurt portfolio performance. So what's the big takeaway here? Behavioral finance isn't just theory, it's a mirror. It helps you understand your own biases, not just the markets. And if you can learn to spot when you're being emotional, irrational, or overly confident, you can start making better decisions. That's powerful stuff, not just for passing CFA level 1, but for your entire career in finance. I hope this section hit home for you, because at the end of the day, markets may aim for efficiency, but they're driven by human beings. And humans, we're anything but perfect. By the way, if you're thinking, whoa, that was a lot of terminology, don't worry, we've got you. All these behavioral biases are packed into our FinQuiz battle-ready summaries. These aren't just summaries, they're strategic tools to help you retain the right info in the shortest time possible. Whether you're prepping for mocks or brushing up before bed, these summaries have your back. Grab them on our website and stay ahead of the curve. The link is in the description. Thanks for staying with me through this detailed look at market efficiency. Go ahead and give yourself a well-deserved pat on the back for taking the time to truly understand these concepts. Trust me, it'll pay dividends, pun absolutely intended, not just in your exam results, but in the way you think and act as an investor in the real world. If you found this session helpful, don't forget to like and subscribe and keep learning with me. There's plenty more to come. And remember, understanding how markets work is just part of the journey. Learning how you react to them, that's where real growth begins. Keep grinding, stay consistent, and trust that the clarity you're building now will not only help you pass the exam, but shape you into a sharper, more confident finance professional. Good luck, happy studying, and I'll see you in the next one.